There is a rule quietly shaping how millions of Americans receive their monthly benefits. It doesn't make headlines every day. It doesn't show up in flashy news alerts. But it can determine whether you get your full payment on time or whether your money gets delayed, reduced, or disrupted when you least expect it. And almost nobody understands how it works until something goes wrong. If you depend on SSI, SSDI, Social Security, or VA benefits, stay with me until the end of this video because by the time we're done, you'll understand exactly how this new $200 banking-related rule could impact your deposits, your account safety, and your financial stability. This isn't hype. This is about how your money moves through the system and how small banking changes can have big effects on benefit recipients. Before we go any further, let me say this. If you've ever felt like financial rules are confusing on purpose, like nobody explains how banks, deposits, or government payments really work for everyday people, this channel is for you. I break down money topics in simple language, without jargon, without fear tactics, and without protecting corporations over people. I'll be uploading more videos about benefit protections, banking rules, deposit changes, fee structures, and how to protect your income before problems happen. So if you rely on government benefits or just want to understand how to keep your money safe, hit subscribe now. Not for the algorithm, but so you stay informed. All right, now let's talk about what this new $200 rule actually means and why it matters for SSI, SSDI, Social Security, and VA recipients. To understand this properly, we need to step back and look at how benefit payments move through the banking system in the United States. When the government sends out monthly payments, whether it's supplemental security income, Social Security disability insurance, retirement benefits, or VA compensation, those funds don't arrive in cash. They go directly into your bank account through electronic deposit. That system is fast, efficient, and generally reliable. But here's where things get important. Your bank controls how transactions are processed once that money arrives. And for many years, banks have had significant flexibility in how they handle account balances, especially when it comes to overdrafts, holds, fees, and transaction timing. Now, why does this matter for benefit recipients? Because many people who receive SSI, SSDI, or VA benefits live on fixed incomes. That means their monthly deposit is often carefully planned to cover rent, food, utilities, medications, and transportation. There isn't much room for error. If a bank processes transactions in a way that causes an overdraft, even by a small amount, fees can quickly follow. Traditionally, overdraft fees have been around $35 per transaction. That means if your balance drops slightly below zero, you could get hit with a charge that is a large percentage of your monthly income, especially if you're on SSI. Now multiply that by 2 or 3 transactions, and suddenly a small timing issue turns into a serious financial setback. That's where the new 200-related banking protections come into play. The rule being discussed focuses on limiting excessive overdraft practices and requiring stronger protections for accounts operating at lower balances, especially balances around or under $200. Why $200? Because accounts with very low balances are statistically more vulnerable to fee cycles and financial strain. The rule aims to prevent banks from repeatedly charging high fees that disproportionately impact people living on fixed or limited incomes. For someone receiving SSI, SSDI, Social Security, or VA benefits, this matters in a very practical way. It means banks are being pushed toward clearer fee disclosures, stronger limits on excessive overdraft charges, greater transparency in how and when fees apply, and in many cases, lower or eliminated overdraft fees entirely. Now let's be real about something important. This rule doesn't automatically change how your benefits are deposited. Your SSI, SSDI, Social Security, or VA payments will continue to arrive the same way, typically through direct deposit. But what it does influence is how banks handle your account once that money arrives. And for people who live close to zero balance at certain points in the month, this can make a meaningful difference. Think about this scenario. Your benefit hits your account on the first of the month. You pay rent, you pay utilities, you buy groceries. By the third week, your balance is low. If an automatic payment goes through slightly earlier than expected, or if a transaction posts in a different order than you assumed, you could accidentally trigger overdraft fees under old systems. The new regulatory pressure around low balance protections is designed to reduce that risk. Now, I want to zoom out for a moment because this isn't just about one rule. It's about a broader shift in how regulators view consumer banking protections. For years, consumer advocates have argued that fixed income recipients are especially vulnerable to fee-heavy systems. When your income is predictable but limited, even small charges can have large consequences. The new approach focuses on fairness and proportionality. That means if a bank offers overdraft coverage, the fees must be more transparent and more aligned with the actual cost of providing that service, not structured in a way that repeatedly extracts revenue from customers with low balances. This is especially relevant for benefit recipients because many accounts receiving government deposits fall into that lower balance category during parts of the month. Now, does this mean everything becomes perfect overnight? No. Banks are businesses. When one revenue stream changes, they may adjust other parts of their pricing structure. That could include monthly maintenance fees, service charges, or eligibility requirements. That's why awareness is so important. This rule isn't about telling you not to trust your bank. It's about making sure you understand how your money is handled and making informed choices. So what should you do right now if you receive SSI, SSDI, Social Security, or VA benefits? First, review your bank's fee schedule. Find out exactly what they charge for overdrafts, low balances, and account maintenance. Many people have never looked at this information, and that's understandable. Banks don't always make it obvious. Second, consider opting out of overdraft coverage if your bank allows it. That way, transactions will simply be declined instead of processed with a fee. Yes, it may feel inconvenient if a card is declined, but it can prevent expensive surprise charges. For fixed-income households, preventing fees is often more important than convenience. Third, consider alternatives. Credit unions, online banks, and low-fee financial institutions may offer more favorable structures for benefit recipients. Competition in banking has increased significantly, and moving your direct deposit is usually straightforward. Your benefits are yours. You have the right to choose where they're deposited. Now let's talk about the bigger picture. After financial disruptions in past decades, regulators have focused more heavily on protecting consumers from fee structures that can trap people in cycles of charges. Whether you support regulation or prefer market-driven solutions, one thing is clear. When policies reduce unnecessary fees for people on fixed incomes, that can directly improve household stability. For someone receiving SSI, even saving $35 matters. For someone on SSDI managing medical expenses, avoiding 2 fees could cover part of a prescription. For a veteran receiving VA benefits, fee reduction can mean more predictable budgeting. Small changes in banking rules can translate into real-life impact when margins are tight. This isn't about politics. It's about understanding how your money flows through the system and making sure you are not paying unnecessary charges simply because you didn't know the rules. Your bank should work for you. You shouldn't have to fight to keep your own benefits. So here's the takeaway. The new 200 related banking protections are designed to reduce excessive overdraft practices and improve transparency, especially for accounts operating at lower balances. If you receive SSI, SSDI, Social Security, or VA benefits, this is something worth paying attention to. Check your account, understand your fees, consider your options, and stay informed. Because when you understand the rules, you stop being surprised by them. And that is how you protect your benefits, your stability, and your peace of mind. If you found this helpful, share it with someone who receives government benefits. Many people don't realize how banking rules affect them directly. And if you want more clear, practical breakdowns like this about benefit protections, banking changes, and money safety, make sure you're subscribed. Your money deserves clarity. And now, you have it.